Welcome to XM.com. You're watching today's market comment by Mario Sajikiriakos. I'm Cristina Marujos. The Japanese yen blasted higher on Thursday, gaining 2% against the US dollar after the governor of the Bank of Japan provided the clearest indications yet that the era of negative interest rates is about to end. Speaking before Parliament, Governor Ueda said that calibrating monetary policy will become more challenging heading into next year, adding that his central bank has several options about which policy rates to target once it exits negative interest rates. His comments lit a fire under the Japanese yen as traders ramped up bets that the Bank of Japan will be the sole central bank to raise rates next year, flying against a global rate-cutting cycle. Market pricing suggests the Bank of Japan will exit negative rates by April after it evaluates the outcome of the spring wage negotiations. The yen was up almost 4% against the dollar at one point yesterday, but the advance was halted near the 200-day moving average, and the currency ultimately trimmed its gains in half. All told, the stage seems set for the yen to shine in 2024 as the forces that devastated the currency over the last couple of years go into reverse. The latest surge may have been the opening act of the yen's long-awaited trend reversal. As for today, all eyes will fall on the latest U.S. employment report. Nonfarm payrolls are projected to have risen by 180,000 in November, while the unemployment rate is seen steady at 3.9%. Meanwhile, wage growth is expected to have lost some steam in annual terms. In terms of any potential surprises, the tea leaves point to a disappointment in this employment report, following a streak of underwhelming labor market indicators. Unemployment report that falls short of forecasts today could reinforce bets of heavy rate cuts by the Fed next year, and by extension, inflict some damage on the dollar. Shares on Wall Street resumed their AI-powered rally on Thursday, with the tech generals leading the charge after Google unveiled its latest artificial intelligence model, propelling its stock price more than 5% higher. In general, stock markets are currently priced for perfection. Valuations are stretched, and earnings assumptions seem overly optimistic heading into a global economic slowdown next year and a U.S. presidential election that historically dampens market performance in the lead-up. The risk-reward profile for equities does not seem very attractive here. This was today's market comment at XM.com. Have a great weekend.